Okay, all right. So first of all, thank you very much for the invitation. I think it was a great idea to have this event. Speaking about CBDCs, actually, it turns out we had a good plan with the talk that you just heard, because I'm going to take some of these points and also put them in a slightly different angle. I think we'll have a very nice discussion, because I think it's a great topic to explore together. So first of all, I'm setting the tone of this talk from the angle of digital currencies in general, and I think it's an interesting question to explore. Digital currencies are here. They've been at the forefront of a lot of developments in fintech, or at least a certain part of fintech, for some time now already. And I think it's very interesting to ask the question: is this really a disruptive new technology, as a lot of people advocated for a number of years, or this is just the solution that we're trying to find a problem to solve with? And in order to be able to understand this, I'd like to take a step back, just take a first principles approach and say, what is the bare bones of a payment system? Let's take a step back. Let's try to disengage with all knowledge we have about how these systems work. And I'm sure in this room there is a lot of experience with payment system. And let's just think about the bare bones of a payment protocol. So we have people that they would like to transfer value. And as it's common in protocol design and in cryptography specifically, we give names. So there's Alice and Bob and Charlie. They want to do stuff. So here we want Alice to send some money to Bob. And the way that payment protocols and payment systems are implemented, they have either a coin-based approach or an account-based approach. And in the case of coins, there is a transfer of coins between Alice and Bob when a payment has been made. In the case of accounts, we have a debiting and crediting of the accounts of the respective parties. And depending on the two approaches, I think it's worth again to think how do you actually implement this very important element of a payment system, which is the state of a payment system, which you might also translate with the important question, where is the money? Right? That's a very important question that the payment system should be able to answer at any time. Right? So how does a payment system answer the question, where is the money? And in the case of we have two major ways, and this is not about computer systems or cryptocurrencies. I mean, again, this is first principles. So we have two major ways of doing that. So we can do that with some form of physical tokens, right? So people historically have used all kinds of physical tokens to do that, right? So they've used shells, they've used paper, they've used coins, metal coins. They've used all kinds of things, all kinds of physical tokens. And the way that you use the tokens, obviously, is that you have some way of exchanging tokens. Now, it's interesting here, by the way, to point out that we don't need to restrict ourselves to, actual physical tokens that are not digital. You can actually think real digitally enhanced tokens being used here. And in fact, also the work that we do at the lab, there is very interesting work based on quantum technology that can actually create digital tokens with very interesting properties that somehow maintain both the qualities of physical tokens, but also the ability of being digital. So the token approach, I just want to highlight, is not just a historical approach to think about payment system, but it's something that is also at the forefront of some of the research in payment systems today. Of course, the moment you have tokens, the moment they have a physical embodiment, you have all kinds of issues about how safe is the particular embodiment of a token, right? On the other hand, the state can come also can also be encoded in the form of a database. Now, that's a completely different approach. And I think like what's important from the database approach is that the key point is that we store somewhere where is the money. So we try to answer this question by storing this information in a database. And then, of course, we have to worry about like what happens if the state of this database is corrupted. And for this, especially now, in the way we organize database systems, there is a lot of know-how and information technology about how is it possible to create these database systems that are resilient and can tolerate hacking or all kinds of types of failures. So now there are a lot of ways that you can like view the differences and distinctions of these two approaches, but I'd like to emphasize one particularly interesting one from the angle of this conversation today. The physical token approach is less compatible with being digital. I mean, naturally, there is a physical token there, right? So it's, you know, it's less compatible with being digital. And the database approach is more easily conducive to a digital implementation. But on the other hand, there is another distinction between the two, that the physical token approach somehow emphasizes self-custody more. So you have ownership of those tokens, like the money is in your pocket. I mean, answering the question, where is the money? It's pretty clear where is the money. It might be exactly in your pocket. And the database approach is much less emphasizing self-custody. The money is clearly not in your pocket. It's in someone's database. It's an entry in someone's database. And of course, you rely on the integrity of that database to make sure that, you know, any payment you want to do is going to be honored. So that's an important distinction. And, you know, for the sake here of just giving you a bit of perspective, there's a few ways that you can implement all these systems in various combinations. In this slide, I'm just giving one example of how is it possible to implement money digitally by using a database that has accounts. I think like one key point here is that transactions can be signed, and somehow here we have the ability of authenticating transactions. Now, this already is not something which is modern. I mean, this is something that you can think of it as the way that business is done right now. I mean, the smart cards that we all have and use for credit cards and debit cards work pretty much at that level. What's important in these systems is to be able to maintain safely the state of the system, being able to make sure that Alice wants to make a payment, is capable of broadcasting these transactions, and that the maintainers of this database are capable of processing these transactions faithfully, right? So these are all things that we have to worry about. And there's a lot of security pitfalls that can happen here. So for example, transactions can get lost when we broadcast that transaction to the system that's not done reliably. This can be done in a way that the state of the system can become invalid, so we have to worry about how do the servers, let's say, that maintain that state reconcile any inconsistency. And you can have all kinds of other issues, of course, like attacks can be replayed, transactions can be replayed, so we have to be able to make sure that there are ways to resolve such, if you want, cybersecurity considerations. So I want to say, without going into further details here, so these are things we've been particularly good mitigating, right? So there are problems, there are cybersecurity attacks, but these are things that the banking industry and in general the cybersecurity community has addressed over, you know, a lot of, you know, substantial work that has happened over decades. And finally, we are today here and able to enjoy digital payments over the internet that are done with reasonable expectation of security. But now there is another kind of there's another kind of type of a pitfall that one can be worried, and these are systemic pitfalls. Because okay, I mean, so far I was talking about, well, there's a database that asks like, where is the money? But you know, the next question is like, okay, I mean, that perhaps like describes, if you want, the properties of that database, but you have to also ask the question, how is this database populated? Like, who creates the money? Why the money exists in the first place, and who has it? And this has to do with the systemic aspects of that system. So in the typical case of a fiat currency system, there's a central bank. The central bank is in cooperation with commercial banks and financial institutions, and there is a way to create money, to manage money, and do that in a way which is auditable and sound, so that these databases, which in the case of the system right now stay with you know, the central bank and commercial banks and financial institutions, are populated properly, and the supply of money is controlled and managed by the central bank. So that's the case for fiat currency as we are today. So what happened in 2008, 2009? So there were like important events that happened at the time. First of all, we had the global financial crisis that created a number of ripple effects in the global financial system, changed regulation, had quite important impact in the way that the financial system works. But it also had another development, which was the motivation to create and launch and make popular the Bitcoin system. And you might think of the contributions of the Bitcoin system in various different ways, but the one I want to highlight here, or the ones I want to highlight here, is that, first of all, looking at it from the perspective that we were looking at payment system before, it did something new. So it took like the somehow database approach and married it with self-custody. I mean, that seemed like incompatible if you look at it from the way I was lining it out, right? Because somehow self-custody was something that we used to enjoy with physical tokens, and the database approach, which was digitally compatible, was something that we got by giving up self-custody. So apparently, with Bitcoin, what happens is that it's possible to have the two combined. And furthermore, do that at a global scale. And I should say that you might ask also, like, what is the other motivation behind such a system? So the other motivation and other elements in its design were there to mitigate potential systemic failures. So in the post-2008 world, after the global financial crisis, there was a distrust in the way that the banking system works, and a number of people understood that banking failures can be a reality, banking failures even, and not just in developing countries, but banking failures in the developed world are a possibility, and this is something that we may have to be concerned about. So these type of systemic failures are an integral part of the motivation of the Bitcoin system, which was launched as, as a payment system. There are a lot of downsides of the Bitcoin system itself, though, and I'll just highlight two of them that are important from the perspective of payments. Like, one has to do with volatility, and this is also the reason why Bitcoin is not really successful and hasn't been successful as a payment system, has failed as a payment system exactly because of this high volatility. And a few other aspects as well, but this is one of the major aspects. And furthermore, the other dimension here is that when you have self-custody, I mean, self-custody comes with a great responsibility. I mean, the money is in your pocket. So you have to worry about this implementation of self-custody. So, and the way it was done with Bitcoin, at least in theory, was something that was feasible, but in practice, it created a lot of problems for users of the system. And we had issues of lost keys, of hacking or phishing, of making mistakes, of clunky software that didn't make it easy for people to use the system or made it possible for them to do all kinds of mistakes and mismanaging the money in their pocket. Despite that, there was a boom that you must all be quite familiar with. And together with Bitcoin, there was a number of other cryptocurrencies which perhaps today are measured in just about less than 10,000 that try to offer all kinds of different features and capabilities, including programming, scaling faster, stabilizing, reducing volatility, doing fast settlement, being more energy efficient, and so on. At the same time, there was a small industry was emerged that tried to solve the problem of self-custody in the context of Bitcoin. And we had like all kinds of devices that tried to answer the question, how do we make it safe that someone can have money in their pocket in this new system where essentially what's happening is that the user has to be in control of a cryptographic key and has to make sure that this cryptographic key is used according to the intent of the user. Because this is one of the biggest problems that we have in, not only in the case of Bitcoin, but I would say in any type of cryptographic system. So cryptography is based fundamentally on the use of a secret key to separate the rightful owner of a certain cryptographic functionality against everybody else. Right? So, and the owner of the cryptographic key should express their intent by using that cryptographic key in the way they want. And the problem that we have frequently in cryptography is that the intent of the user is not reflected in the actual use of the key, right? So basically the user wants to do one thing, but somehow the cryptographic key is used in a different way, right? And there's like now a small industry that has emerged around making sure that the intent of the user and the function and the way that the cryptographic key functions match. Another important development is decentralized finance, which basically exploits the fact that we have these programmability features of this system, and it's possible to facilitate disintermediation. And the key point here is that at least the initial developments were not trying to do something novel, but the amazing part was that they were disintermediating. And this is actually pretty remarkable. The initial coin offering craze that happened a few years ago was exactly pointing to that fact. It was not something new. I mean, people were asking other people for money to invest like for a very long time. But now it was possible, based on these systems, to do this at the global scale without actually having to go through any kinds of complex hoops in order to access essentially a very large population of potential investors. But that was not just that. There was a development of other kind of financial tools that were new compared to what you have in the traditional world of finance. So just highlighting a few things that are novel in this world. We have tokenization of assets, automated market makers, and other kind of systems that facilitate trading, flash loans. I'm not going to go to the details, but there's like a number of elements that are novel to that new financial ecosystem that seem to be quite attractive from the perspective of building new financial instruments. And needless to say, the inclusion and reach is unprecedented in the systems because suddenly there is a platform that is global scale and everybody has access to it. I mean, that's in itself is unprecedented. That's not something that we used to have before. I mean, you have to register with a broker. We have to go to a particular stock market. No, this is kind of new, right? So this is a global financial market that people can use just having a computer that's connected to the internet. So together with all that, there was a company, Facebook, that started an effort to create a digital currency for the world. This effort, as you know, failed, and this is not any longer pursued by Facebook or Meta, but it set the wheels in motion, and it created this concern on the central bank side that somehow, I mean, perhaps Bitcoin in itself was not going to be successful as payment, but if Facebook or another company, or another one of the big technology companies, if they actually operated and issued a currency, they would have the potential to literally control global finance. So they would have an unprecedented influence in financial affairs. So that created like this, flurry of work all across different nations. So just to give you here, there's more than 100 countries that are at some different level of development of central bank digital currencies. And this is something right now that is not, I mean, it's questioned, but the thing is that even if you find some reason not to do it, the biggest issue is that, for example, like in Europe they say, what if China does it? In China they say, what if the US does it? So no one wants to be the one that does not do it, because there is a danger that whoever does it first and does it well will become a de facto standard for financial transaction settlement globally. And this is actually a really important target. So, coming to wrap up in just a few minutes, I just want to explore a little bit this question that I said, like, is this a disruptive technology or a misguided technological advance? And I'll just like highlight, the good, the bad, and the ugly. Just picking on thinking about this question and starting like from the bad. So in the realm of payments, when you are in developed countries, there is no real unique selling point here. Like, payments are already digital. Like, in other words, in the developing world, in the developed world, like where we have like a robust payment infrastructure, everything is digital already. There is nothing like digital currency is going to do in the way you get your coffee or in the way you do like, your day-to-day things. Like this, the intention here is that it's exactly the same with what you have now already, right? There is nothing new there already. Money is digital. Cryptocurrencies as they are today, they are mostly failed as currencies. Nobody wants to use them for payments. There's various reasons for that. Volatility is one of them. And furthermore, all these regulatory aspects are at the time being nebulous, very challenging to enforce in that setting. And a lot of people that do work in that broader industry, they always do that with the uncertainty that they actually don't know whether the system they build is actually legal in the jurisdiction that they want to operate. So that's quite bad. And on top of the bad, there's ugly things that are happening as well. So self-custody, as I mentioned, comes with serious downsides. Well, you lost your Bitcoin. There's no one to phone and say like, well, could you please, fix that for me? There's nothing that can help you there. Self-custody comes with serious consequences. Privacy is terrible in most of these systems. It's surprisingly bad. It's actually, despite like whatever people think or kind of thought when they were developing that systems, is actually extremely easy to track payments and transactions in these systems. So there are ways that privacy could be enhanced, but in most circumstances, it's actually quite hard to do. Further, and perhaps even worse from a financial perspective, despite their supposed transparency of these systems, there's a lot of information asymmetries and centralization, as well as information silos that happen in the cryptocurrency space that make it very hard for end users to understand, detect. So it's very common for end users to fall victims of scam, or various scammers, or even like operations that are done that are not done up to standard in any possible way. I mean, FTX is, for example, a great example of that. Terra, another example of that. Right? So this can be quite hard to detect for the end users. Now let me come to some of the good things I want to say about this. There is a lot of potential for being inclusive here. And I have to say, okay, I mean, perhaps living in a country like the UK is not something that you can feel that in a very strong way, but in the developing countries, it's more likely to have a mobile internet rather than a bank account. And that's an important point. So there are people that are paying tremendous amounts of fees, let's say, just to transfer funds from one country to another, in case, let's say, there are migrant workers in a country and they want to support their family back home. Self-custody, with all its bad effects, it mirrors self-sovereign identity, which is one of the important topics of the time. And we can go on discussing about this, and I'm glad it was highlighted in the previous talk. But I think the key question here is that who controls people's identity infrastructure at a global scale today and in the future? This is a very important question, and we have to ask the question, are we in control of our identity, or is this our identity and its attributes is delegated to a company that may not even be present in the country that we live? And finally, you have like all these aspects about programmability and smart contracts that through central bank digital currencies and other systems like so-called custodial stablecoins, which is basically like CBDCs but operated by private companies, they can be used to resolve all these volatility considerations, give us basically currencies that are as good as fiat, but also have features that are consistent, for example, with decentralized finance and some of these developments that we've seen in the cryptocurrency space. Finally, I want to highlight regulatory technology, because I mentioned regulation as one of the big problems of the space, as it is now, but that's because regulation is lagging behind being nimble enough to operate in this new world. But this doesn't have to be like that. There is tremendous potential to innovate in the regulatory space and develop systems that automate regulation and build it in as part of the infrastructure. And I think there is tremendous potential for doing things in that space. So with this, I think like I'll probably have to wrap up. I'm not sure if I have any more minutes left, but probably I should wrap up here, looking at my sheet. So I just want to say that everything I said and a lot more is part of the research that we do here at the Blockchain Lab at Informatics, and especially on the topic of central bank digital currencies. We have a number of new systems that we're building right now. And I'm also glad to say my co-authors and collaborators in these systems, Markus Kohlweis and Amireza Sarence, they are just there on the back. I don't have time right now to tell you about exactly like all the details of the work we do, but what we're trying to do is like address all these issues that I mentioned, and making sure we can build that infrastructure that is capable of reconciling privacy and auditability and regulation compliance without sacrificing any of the features that are desirable in these payment systems. So I'm going to skip that. Like kind of details here I had, and I'll wrap up here, and I'll happy to take questions like in the panel later. Thank you.